RBC Royal Bank of Canada just announced record third quarter earnings, but alongside this profit surge, the bank is also flagging rising mortgage arrears. Signs of borrower strain are emerging in its mortgage portfolio. 90-day mortgage delinquencies were up. 0.31% of RBC's residential mortgages are now past due over 90 days, up from 0.24% a year ago. This ticked up 1 basis point from last quarter and 7 basis points year over year. Obviously, 0.31%, not a huge number here. However, the trend of us seeing a steady rise from pandemic era lows is a little bit of concern from my perspective. This trend is especially apparent in the GT. RBC took $881 million in credit loss provisions this quarter, a 34% jump from the $660 million a year ago. And this increase was largely due to higher impairments in personal and commercial banking, including mortgages, according to the report. Now, the Greater Toronto Area really stands out as a hotspot. RBC revealed that Toronto area mortgage delinquencies have climbed from 0.27% a year ago to 0.42% in Q3, which is the highest share of overdue mortgages in any region of its portfolio. In Greater Vancouver, the rate rose from 0.2% to 0.27% over the same period. And again, because RBC's nationwide average was 0.31%, this really underscores how Toronto's housing market is seeing disproportionate stress. RBC's mortgage book continued modest growth, with residential mortgage balances up 3% to $418 billion. CEO Dave McKay touted the bank's relentless focus on clients and long-term growth, but the earnings report also acknowledged mounting stress among some borrowers. And the bank's chief risk officer, Graham Hepworth, noted on the Q2 conference call that high interest rates are straining certain consumers, particularly more economically vulnerable parts of our country. This would be the GTAs of the world that are really driving their impairments these days. In other words, Toronto's expensive housing market and larger mortgages are exposing borrowers to greater payment shocks as interest rates reset higher. And so the Toronto region has seen the sharpest deterioration in mortgage performance in RBC's portfolio. RBC being the biggest bank in Canada, I think that this serves as a little bit of a canary in the coal mine or a bellwether for the remainder of the banks and the economy. Then it shouldn't come as a surprise to everyone. Number one is the interest rate payment shock. Obviously, GTA has many borrowers who bought homes at peak prices with large mortgages and really low rates. As those pandemic era mortgages come up for renewal at much higher interest rates, monthly payments have surged. And Toronto's sky-high home prices meant that recent buyers took on heavy debt loads or higher leverage points, which means that they were more financially stressed or putting themselves in more precarious financial positions just to get the house to begin with. Even with banks extending amortizations to temporarily ease payments, some households are stretched to the limit, and RBC's risk model shows impairments rising as more and more clients are facing challenges in this higher rate environment, which we're just starting. I just did a video on how the renewal wall is just getting here, and we saw an increase in July new mortgages. This is a trend that's only going to continue over the next 2 years as over 60% of mortgages come up for renewal in the Canadian market. The GTA has also seen rising unemployment and cost of living increases, which squeeze household finances. With Toronto having one of the highest unemployment rates for a city in Canada, Ontario's job market has weakened, contributing to more and more borrowers slipping behind on debt. And despite the uptick in arrears, RBC remains that overall portfolio quality is still strong. The bank notes that 80% of its mortgage book is uninsured, generally indicating substantial higher homeowner equity, where your insured mortgages are typically your higher loan-to-value mortgages, where CMHC has to step in and insure them for the banks to be able to do them. And so the bank is of the position that the fact that homeowners built up equity during the housing boom should buffer the bank from large losses even as delinquencies rise. This is really where you want to think about Canada as an equity-based lending market, not an income-based or borrower-based lending market. Our credit market has always been such that people could always tap more and more equity from private mortgages or whatever to try and service that debt, the higher quality, cheaper bank debt lower down the line in their capital stack. I think that's coming to an end a little bit because you're seeing credit contraction and it's harder and harder to get deals done on the B lender or even private side. But that lifeline hasn't completely disappeared if there's equity in the home. The challenge is that a lot of these houses that were transacted in 2021, and especially a lot of these pre-construction condos, there's no equity or negative equity, and borrowers who are in that position where they're having cash flow or payment issues and delinquency combined with equity issues are really out of luck. The only way that they can get out of that situation is basically sell at a loss, but many people can't even afford to sell at a loss because they don't have the equity to pay out or the cash to pay out the losses on the property to make the bank whole or the builder whole or whoever it is. And in a lot of cases, people were actually borrowing home equity lines of credit from their houses to speculate on these pre-construction condos that they planned on assigning. And so I do think that there are further layers of risk that are going to materialize over the next couple of years. And that equity buffer only helps if owners can tap into it. And so the worrying trend in Toronto is that even well-qualified borrowers are starting to fall behind, suggesting that financial stress in the Toronto market is broadening. RBC clearly sees risk trending upward. And the Bank of Canada put out some data on this as well, with the most recent reading being in Q1 of this year, where the share of indebted borrowers behind on payments for at least 60 days in any credit category is 2.6%. And you can see that it's rising pretty substantially from the pandemic era lows. Now, the Canadian Bankers Association observed that Canada's arrears rates are relatively low compared to other advanced economies like the US and the UK. And I would agree with that, although part of me feels like it's a little bit artificial because I think that our accountability in our credit environment is a little bit less. Like we have this thing called the Canadian Mortgage Charter, which means that banks really have to make concessions for people who are delinquent and help them try and sell the house and a lot of other things to try and alleviate financial pressure. Plus, we had that period of time where you basically didn't have to pay your mortgage during the pandemic. And a lot of these things can artificially suppress delinquency rates. One thing I will say from the Canadian Banking Association's most recent report is that they put out this chart showing the unemployment rate and the mortgage arrears. And you can see that they track each other pretty solidly. And we are seeing a rising unemployment rate in Canada right now. And so your mortgage arrears should probably track that. On a long-term horizon, this goes back to the 1990s. You can see we're in a pretty low arrears environment and in a pretty low unemployment environment, although I am of the opinion that could jump up pretty substantially in Canada. And I don't really know how we can fix the unemployment problem, especially with everything that's happening with the amount of temporary foreign workers and unemployment, youth unemployment, and unemployment for newcomers in the Canadian market. And the RBC's experience isn't isolated. They're just the first one to have reported anything like this. I'm not trying to pick on them. It's just they have the data available, and so that's what I'm using. Industry-wide data confirms that mortgage delinquencies are on the rise. CMHC's most recent residential mortgage industry report showed that delinquency rates for all credit products were rising. But as you can see, your mortgage and HELOCs are rising the least. But usually it's the mortgages and HELOCs that are the thing that people fail to pay last, right? Like you're going to go delinquent on your credit cards or your car or your line of credit unsecured before you start defaulting on the things that are secured against your house. And Equifax Canada's latest reports highlight a sharp uptick in borrowers falling behind on payments as higher rates and inflation bite. Key trends including Ontario's record jump in mortgage delinquencies. Ontario's 90-day mortgage delinquency rate surged 71.5% year over year in the first quarter of 2025, reaching 0.24%. Again, a very low raw number, but a super alarming jump. And again, it's easy to have these alarming jumps from a really low base. But this is a record high for Ontario and by far the steepest increase of any province. By Q2 of 2025, Ontario's rate had risen even further, and British Columbia saw the next largest spike, a 33% year-over-year increase. While most other provinces where housing is affordable and cost of living is much more affordable saw only modest rises. And the national average delinquency rate climbed up just slightly from last year. And within Ontario, the Greater Toronto Area appears to be driving much of this increase, with various analysis noting that Toronto's mortgage arrears are now the highest in over a decade, even as cities like Vancouver and Montreal remain below the national average. This would align with RBC's internal figures showing GTA delinquencies well above other regions. Now, Equifax data also show that delinquencies are rising across other credit products, often a warning sign for future mortgage troubles, as I mentioned when I showed you the CMHC chart. Mortgage delinquencies were up only 6.5% year over year nationally, but non-mortgage delinquencies jumped 8.9%. The under 35 cohort saw a sharp increase in credit card and auto loan delinquencies. And this broader debt stress often foreshadows trouble for mortgages since people tend to miss credit card or auto payments before default. And the final piece of the puzzle is this great renewal effect. Part of the surge in mortgage delinquencies is also attributed to this great renewal or renewal wall of the pandemic era mortgages. Equifax noted 57% year over year jump in mortgage originations in Q1 2025, not from new home purchases, but from a wave of homeowners renewing or refinancing their loans at much higher rates. Many Canadians who bought or refinanced at 1.5% to 2.5% interest rates are now facing rates of 4 to 6%, which has dramatically increased payments for those who couldn't lock in low rate on a long-term basis because we're not in a low-rate environment anymore. I had a commenter mention that their rate went up. They're renewing from a 2020 rate below 2% and their payment only jumped up 20%. 20% when you take it and spread it across an entire economy, while all of those borrowers have also been seeing their cost of living increase, inflation costs, and now they have to bear the burden of 20%. Even if they can survive that burden, it's 20% that they're spending on interest, which is a sunk cost, no longer spending on consumer goods or disposable income. And even with some borrowers extending amortization periods, affordability has deteriorated. Equifax Rebecca Oakes observed that while some renewers found relief in switching lenders, affordability challenges haven't eased for everyone. In fact, average monthly mortgage payments for renewals have declined slightly as some stretch out terms, but the average loan size is up 7.5%, indicating many borrowers rolled other debts into their mortgage or took out equity draws according to their debt burden. So overall, these trends paint a cautionary picture. After years of ultra low defaults, Canadian mortgage delinquencies are creeping up from the pandemic era floor. Will they get as high as last cycles? I don't know. Our lending environment is very forgiving to borrowers, and it's probably going to try and continue to be that way. This is how the oligopolistic banking industry, in partnership with the regulators and the federal government, can really try and soften the blow of this major recession and housing cycle and credit cycle impact on the regular consumer. The increase so far brings delinquencies back roughly to 2019 levels. Not a crisis point yet, but the pace of deterioration is striking. The concentration of that stress in Toronto, Canada's largest housing market, where we've already seen huge house price declines and a huge increase of supply coming on the market in the GTA, is what makes this especially noteworthy. And the debt divide is widening. Ontario and BC homeowners are under far more pressure, while some other regions have been less affected, if not unaffected. So what does a rise in mortgage arrears mean for the housing market? By itself, a delinquency rate of 0.3 to 0.4 is still very low. That means 99.6% of RBC's mortgage customers are not in arrears, but the trend is what matters. It tells us that there's a growing subset of financially stressed homeowners, which could have ripple effects. This could mean forced sales and housing supply. As borrowers fall behind on payments, many will attempt to sell their home rather than face foreclosure or power of sale, especially if they still have equity. Rising delinquencies, and we've seen a huge rise in power of sale listings. I've been tracking this. I try and put something out on it once a quarter, and I'll be doing that soon. But these rising delinquencies and power of sales often foreshadow an increase in listings as distressed owners seek an exit. In a hot market, those owners could sell quickly, often at a profit, to pay off the mortgage. But when the market's cooled and there's very little exit liquidity, not a lot of buyers, we're in a buyer's market, that safety valve weakens. And this really drives home how we're in an equity-based market. If sellers can't tap that equity from a HELOC or from a sale, delinquencies tend to surge only when home purchase is slow, when there aren't enough buyers to bail out troubled homeowners at current prices. The jump in arrears in Toronto specifically suggests that the market has cooled from its frenzy and homeowners under financial strain can no longer easily sell to clear their debt, at least not without lowering the price. And that's where we get to further downward price discovery. If arrears keep climbing, we could see more must sell or motivated seller listings hitting the market in high stress regions, and an influx of supply from these distressed sales would put more downward pressure on house prices, particularly in segments with highly leveraged owners. For example, investor owned condos or suburban homes bought at the peak when people thought that they were going to be working from home forever. The next piece is the psychological impact of spiking arrears. You can't really underestimate the power of this. Housing market sentiment in Canada has been softening, and news of rising defaults can further erode confidence. Buyers become more cautious when they hear about homeowners struggling or banks tightening credit. Even sellers may get nervous, fearing prices and this can cool demand. A string of negative housing news like upticks in arrears can deter buyers and lead to a self-fulfilling slowdown. And so if Canadians believe a wave of distressed sales is coming, they may just sit on the sidelines, which does then pressure prices. And we're already seeing early signs. Surveys show a growing share of borrowers are concerned about their ability to make payments and are worried about job losses, according to CMHC's Mortgage Consumer Survey. Consumer confidence is very tightly linked to real estate. When defaults rise, it signals economic stress, which can take that exuberance fueled bidding war, FOMO market, and completely crush it. And that's what we saw in 2022. And I mentioned the Canadian Mortgage Charter. It's important to note that banks and policymakers have the tools to mitigate defaults, which is probably why Canada has such a low delinquency rates. Many lenders, including RBC and their peers, have allowed temporary measures like extending amortizations well beyond the original schedule to keep payments manageable. For instance, TD Bank disclosed over 27% of its mortgage books had amortizations greater than 35 years, though that has since fallen to 6% as borrowers adjust payments or renew into this new higher rate environment and get a new sort of loan structure. And these measures very well could have helped keep delinquency rates artificially low by preventing defaults that might otherwise have occurred. The fact that arrears are rising even after all of these interventions and accommodations that banks are able to give suggests that a point of constraint is being reached. We've really kicked the can down the road as far as we possibly can before we actually have to face real economic consequences for what we've done. Some households, many households, can simply not afford the higher payments, even with extensions or interest-only periods, especially once they hit this renewal wall. And this would imply a continued upward trajectory for delinquencies into 25, 26, especially when you look at it beside that unemployment rate, which is trending up, and I can't see it any version of the unemployment rate where it stops doing that. RBC's own economists have warned that Canadians are more interest rate sensitive than ever and that mortgage delinquencies could return to pre-pandemic levels as unemployment ticks up and rate hikes fully filter through. Pre-pandemic delinquency nationally was around 0.3%, which we are now nearing. And RBC's base case forecast assumes no major housing crash, which, we've already seen the major housing crash in 2022. And I think a grind down is probably what we'll see sustained in downward price discovery, as a lot of the factors that I've already mentioned in this video will continue. But their relatively rosy outlook hinges on most borrowers coping and only a gradual increase in forced sales. However, if financial stress accelerates, for example, the economy enters a recession, which seems pretty much the writing is on the wall already, or if interest rates stay in a higher for longer, which is actually RBC's rate forecast that we weren't going to see cuts from the Bank of Canada, we could surpass those delinquency projections. So the bank is prospering from higher interest rates, but a growing number of its borrowers are struggling under the weight of those rates, especially in Toronto. Mortgage arrears at RBC, while still low, are the highest level in years, and Toronto leads the pack. Broader credit data backs up this trend, as I mentioned. And this surge in arrears is really a warning sign that the housing market's foundation is cracking at the margins. Most homeowners are hanging on, but the stress is likely to push a subset to sell, bringing much needed supply to markets like the GTA and more downward price discovery, but also potentially accelerating the losses that could happen in those areas. So both RBC and industry experts will be watching these metrics closely. I will be as well. So if you want more of this, please hit subscribe on this video and leave me a thought in the comments. How much worse do you think delinquencies are going to get in Canada? What do you think that the peak mortgage delinquency rate is that we'll see in this credit cycle? As always, just want to say thank you for taking the time to watch this video. I really appreciate you taking the time out of your day to watch. It means a lot to me, and I'll see you again as soon as I can.